Do you feel like you're making great revenue, but yet you still feel broke? Today's episode of Savvy or Surrender, we are going to do a case study on a roofing company that I've been working with for a little over 2 years now. And they were doing over $1 million in revenue, but at the end of the year, they still felt broke. So we're going to go through it. We're going to look at their financials and look and identify exactly how we can help you. Hey, this is Stephen Young, your host of the Savvy or Surrender podcast and owner of Savvy Tax Strategies and Bookkeeping. If you are looking for somebody that can help you with your finances, help you understand your financial statements, and also be able to help you with taxes, tax preparation, all of those things that you need to be able to be successful in your business, give us a chance with a discovery call at meetwithsavvy.com. So you can schedule your free discovery call at meetwithsavvy.com. And if you like this podcast, wherever you're checking it out, whether it's YouTube, I would really appreciate it if you liked it and subscribed. If you're on Apple Podcasts or Spotify, please leave us a review. Would love to know how you like the podcast. And if you have any questions or you want to see a future episode, would be happy to take a look at that and see what we can do for you. All right, so let's jump into this. So the roofing company that I want to show you, I've been working with for a couple of years. And when they first came to me, they kept saying, Stephen, we're over $1 million in sales. We're doing well there. We feel like we have a good business going, but at the end of the year, we're still feeling broke. So how do we fix that? And now when I show you the results, you'll notice that the revenue didn't really change that much. It changed a little bit, and we've kind of sanitized the numbers so they're not exact, but I didn't want to give away all of their information and their secrets. But we've kind of changed the numbers a little bit. I'll show you here. Here's the numbers. If you're on YouTube, you'll be able to see the spreadsheet there and what we have. So with these numbers here, we're going to, you can see where we kind of sanitize them a little bit, but you get the idea. These are the percentages are the same. So again, same revenue basically, but we were able to pinpoint some specific areas of what we wanted to work on so that then we could help them to fine-tune their expenses, their material costs, and then be able to make a lot more money and be a lot more profitable, like 200% more profitable. All right, so a little over $1 million in revenue. They did have some seasonal cash flow swings. They're a roofer and in Treasure Valley in Idaho, so in Boise, Idaho. So you've got kind of your shoulders, right? You've got the fall and you've got the spring, and so different depending on the type of business, depends on when they're really busy. So there's typically not a lot of roofing being done in December or January. Now, we've had a weird winter here. If you're in the Treasure Valley, this has been a weird winter, right? Like we've hardly had any snow. In fact, it's snowing today, right now, as I record this podcast. But normally or recently, like we haven't had any snow. So my roofing clients have actually been able to stay pretty busy, which is nice for them. But normally, from February, March until November or so, and then maybe they'll take off kind of those winter couple of months. So they were having those seasonal cash flow swings. How do they keep employees on during the wintertime when there's no work to be had? And then the big issue too was taxes. They just kind of buried their head in the sand. The ostrich effect, I call it, where they just buried their head in the sand because they didn't know how much they owed in taxes. They weren't paying it correctly. All of their expenses got eaten up, and we'll talk about that. And so as that happened, they were, having an issue paying taxes, penalties, and interest and all that kind of stuff. And then, of course, that meant that the owner wasn't getting paid very well either. It was kind of like, whatever was left at the end of the day after he did all the other expenses. Their big issue that we corrected, and it's all based on this book with Profit First. Now, it's not the only strategy that we used, but it is definitely a book that helps you to understand your priorities in your accounts and also just help you set up multiple accounts. And so we'll kind of go through that and exactly what we did with what I call the savvy path to cash to help them beyond just simply opening up some accounts, but also help them understand their cash and what they can do with it to get lines of credit, things like that. So the one bank account it ultimately ends up with just kind of some financial soup, right? You just have all of the money there and you have no idea really what to be doing with it and where to break it down. So we'll talk about that. And the key lesson here for this case study, I would say, is that high revenue does not necessarily equal a healthy business. You can grow broke. You can have too much money coming in or in too many expenses that takes up all that money, and you sit there at the end of the year looking at your income statement and you go, wow, I made $1.2 million. Where did it go? Like why is there no money left for me? So here's what happens with, the big issue, the real problems is that there's no allocations specifically set for profit or owner's pay or taxes. And so what ends up happening is when you're just looking at this one account, you price jobs too thin because you want to stay competitive, right? You got to compete against the next guy. There's lots of roofers out there. And so you price your job too thin just so that you can stay competitive, so that you can get cash in the bank, so that you can pay your expenses and your guys and all that kind of stuff. And so you're on this treadmill of just constantly going around with these jobs that you probably didn't want, that you're not making enough money on because you have all these expenses that you have to meet. So we can address that as well. So decisions made off of bank balance instead of numbers is where the biggest issue always comes in. So I call it bank balance bookkeeping. And what that means is you open up your app and you see all your accounts, or you see your one account, I should say, and you click on that, and that's all you see. And so you see, let's say $10,000, and you're like, okay, I've got rent, I've got, payroll. So I left with $6,000. Cool, I can do this, or I'm going to do these ads, or I'm going to do this coaching program, or whatever it is. And as you fill up those expenses, it's called Parkinson's Law. And basically what it says is that whatever you have will expand to meet the capacity. So if you have 2 months to get a term paper due, you wait 1 month and 3 weeks and 6 days to get that term paper done. If you see you have $10,000 in your account, you find expenses to expand to match that amount. And then you end up with zero in there. And you haven't set money aside for taxes. You haven't set money aside for your pay or profits, never mind the profit. And so now you're stuck wondering when the next job's coming in. So this is where most contractors end up surrendering. And that's where the path to cash, what I like to call the savvy path to cash, helps you with your business. We don't want you to surrender. We want you to be savvy. Here's what we're going to do. And according to the book, Profit First by Mike Michalowicz on Amazon, the first thing we're going to do is we're going to open up a couple of bank accounts. Now, this doesn't have to be scary. It can be just a couple of them. If you're already, let's say you're an S Corp and you already have yourself on payroll, maybe you don't need an owner's pay account. You can look at that one and say, okay, maybe that one is overkill. I don't need an owner's pay account, but I do at least need a tax account. I do at least need an expense account, and I do need a profit account. And then, of course, we have our income account where all the money comes into. That's just kind of the holding account. All the money comes into that income account. And then we want to immediately start putting money into that profit account. We want to start some allocations. We're going to be small, realistic. Again, if you check out the book, he goes through a exercise on figuring out what kind of allocations we should be doing. But in the beginning, even 1%, if you just start with taking all the money you made, let's say you're going to do this on a weekly basis. Let's say every Tuesday, you look at the money in your income account and you allocate it based on the percentages that you've done for the exercise in the book. So the first thing is profit. Now, one of the big issues that I find, there's two downsides to Profit First, or what I have found with people that try to implement Profit First. Number one is they get the accounts open. That's usually pretty easy. They'll go to the bank and they'll get those done. But then they don't actually start allocating and they don't do it. They don't move forward with it. So then they just have these accounts there. So that's the first holdup. Then if they do start going and allocating, the next issue is they don't adjust their expenses. Remember, we have that Parkinson's Law where all your expenses have expanded to what normally is in your account. So if normally in your account is $10,000 and now we are partitioning money out to different areas, well, your expenses are still $10,000. Now we've got this money in different places, and your expense account, your operating expense account doesn't have $10,000 in it. It's got $6,000 in it. And now you have overdrafts and it doesn't work. And so you just stop doing it because you didn't adjust your expenses to do it correctly. So the easiest way to get around that is to allocate small. Make a small change. You can go profit, go 1%, 2%, whatever you feel comfortable with, but I wouldn't jump to 10 or 15% or 20% unless you're already very profitable and you're just doing profit first to help you be even more profitable and be even more educated on where your money is going in the financials. So profit account, 1%, 2%, keep it simple. Your owner's pay, you want to make this intentional. You want to make sure that you are paying yourself. If you are going to open an owner's pay account, if you're a sole prop or an LLC, you don't have yourself on payroll, open up an owner's pay account and put in the 30, 35, 40% into that account. You'll see on my case study here where we actually are, they increased their pay, their owner's pay, and yet they also still were more profitable because of how we set these up. And then taxes, when you have a tax account and you're putting money in there, you no longer have this surprise attack on taxes. There's no IRS coming down your throat because you already have it set up correctly. So what ends up happening is you get to stop asking, can we afford this? And start saying, this is what we can afford. You know what's in that operating account, so you know what you can afford. And you base it on that, because in that operating account is whatever's left. If you've taken money out for profit, couple points, you've taken money out for owner's pay, 30, 35, 40%, depending on your level of income. You've taken out for taxes, could be 5%, 20%. The book generally puts it at 20, but it really just kind of depends on what your situation is. 20 might be overly aggressive, especially if you're an S Corp and you already have your own payroll set aside. 20% may not be necessary. So you can look at that too and see where that percentage needs to be. And that's part of the reason of having somebody help you implement this process. And then the execution, right? Where most people quit, just like I said. All right, so let's look at this account real quick. And as you can see here, we have revenue of $1.2 million. And if you're not watching the YouTube video, you're okay. I'm going to kind of go through the numbers for you so you'll be able to visualize it. If you're in your car, don't close your eyes while visualizing this. Just follow me as best you can. Before they started working with me, their revenue was at $1.2 million. Afterwards, it was still $1.2 million. I had nothing to do with that. Their cost of goods and materials, their total gross profit was $420,000. Materials was also $420,000. They had $300,000 in labor, $60,000 in subcontractors. So their total cost of goods sold was $780,000 before they met me. After they met me, we went through, we fine-tuned some of the materials. We found that if we paid it faster, we would be able to get a discount on some of the materials. So all in, we increased our gross profit to $445,000. So total COGS went down from $780,000 to $755,000. So only about 3.2% less. But that made a difference of an increasing our gross profit by 6%. So we went up to $445,000. And then we went into, if you go into the expenses, I have laid out here, office, admin wages, owner's pay went from $60,000 to $85,000. So we increased our owner's pay by 42%. And then our rent, we were able to get a little bit of a discount by paying earlier on the rent. Vehicles, we also were able to go down a vehicle because we were being more efficient. And so we didn't need to have as many vehicles. Insurance went down a little bit as well because we were able to help them with, well, one, the vehicle, we had less vehicle. And so the insurance went down there, I believe. Also, the overall wages went down a little bit. And so we were able to save on some workers' comp. Advertising, because we were being more efficient, we were able to lower the advertising. And also, we just didn't have the need for as much advertising to be able to maintain the same amount of income. Equipment and tools, we spent a little bit less there. Again, some of these things you might see, well, why are they going down on this? Like equipment and tools, maybe I can't help that. Yeah, maybe you can't at some point, But right now, we were able to help that. They were set up. And so rather than just simply spending money on a new tool because they saw money in their account, the point was they looked at their operating expense account. They knew what was in there, and they made a decision based on that. And they said, okay, we can't do it then, right? We're not able to actually buy this tool right now. And it wasn't something they had to have, so they were able to avoid it. So altogether, the total operating expenses stayed at $400,000 before they met me and after they met me. The big difference there is that if you look at owner's pay, they went from $60,000 to $85,000. So they increased their pay by $25,000. And then the big change here is the net profit. Instead of $20,000 before they met me, they made $45,000. So they made an extra $25,000 there, an extra $25,000 in their owner's pay, which is where they were able to make an extra $50,000 with the same revenue, just tightening up expenses and really looking at the numbers, looking at their financials and seeing what are they spending money on? Do they need to? Do they need to be spending the money on that? So rather than not knowing when their money's coming in or only giving themselves a draw when they saw their bank account to their personal bank account and saw that it was negative, and so they put money in there and just transfer money, it became intentional. Every week they had money going into that owner's pay account. Every week they transferred money into the tax account. They were now on time with their taxes and their quarterly estimated payments. So these better decisions equals less stress and more control. They walk out of my office feeling much more in control of their business, of their finances, and they're able to sleep better too, is what I end up hearing. So they didn't have to work harder. They just simply worked smarter with the cash that they had. Now, what does this prove? It proves that cash flow is a system problem, not a revenue problem. When you have the right system in place, you're able to do everything you need to do with the amount of money that you have. You just have to be smart about it. You don't rise to your income. You fall to your financial structure. It's the same biblical principle of having your house built on rock rather than sand. So when you have the correct financial structure, you're able to thrive and grow and be able to really expand your business in ways that you never thought possible because you have the right foundation there in place. One of the products that we're coming out with is called the Savvy Boss, or the Business Operating Success System. And this is going to essentially replace an employee for you that's going to do all of your bookkeeping, your payroll, your taxes, as well as CFO and cash flow advisory, so that you know exactly where your business is. It's going to replace 2 to 3 people. It's really meant for somebody who's in the $1 million range. So if that's something that you're thinking would make sense for your business, I would love to talk to you more about it. If your revenue stopped growing tomorrow, would your business survive? If your revenue stopped growing tomorrow, would your business survive? If it was doing the exact same amount of money every single month, or are you growing in expenses faster and you need more and more revenue to be able to just match the expenses? That's one of the things we cover in our Savvy Boss program with the financial advisory and the cash flow analysis. So if that sounds like something that you want to have, cash flow structured, no more guessing on taxes, build a business that actually pays you and is profitable, that you could sell, that you could give away to a family, whatever it is, you don't surrender to the chaos. Build a system that makes profit automatic and helps you to know exactly where your financials are, what loans you might be able to qualify for, how you can expand. If you've got the extra cash in there, think about going from an extra, just realized it wasn't on me the whole time. If you go from a net profit of $20,000 and you go to $45,000, what does that extra $25,000 allow you to do? Does it allow you to invest in your business? Does it allow you to invest in a retirement plan? Whatever it might be, in addition to the $25,000 that you already paid yourself to. So if that's something that sounds of interest to you, I would love to be able to have a call with you and see if it makes sense. You can go to meetwithsavvy.com and schedule your discovery call. And with that, that is the wrap on episode number 20. the roofer who makes $50,000 more a year without having to make any more revenue. If you liked this case study and you want to see more of those, please reach out. Let us know. You can email us at podcast@savvytaxstrategies.com, or you can always go to savvyorsurrender.com and leave a message on our podcast website there. Thank you so much. I look forward to talking to you next week.